Hi, and welcome to our webinar today. Today, I am pleased to welcome Paul Sloat, CEO of Green Drake Advisors. Paul today is going to be talking about the economic outlook for business owners over the next 4 years. I think, recent election has some people a little bit rattled. Business owners are wondering how this might affect their business. And Paul, in his capacity as an advisor, studies markets and conditions and really pulls together a lot of information and data in order to advise business owners and his clients, on their economic goals. And so he has just a wealth of information to share with us today about what business owners might be able to expect in the coming administration and over the coming couple years. So without further ado, I will let Paul Sloat, again, CEO of Green Drake Advisors, take it from here.
Thank you, Sarah, for having me. Yes, we're looking at a new presidency and a new administration, and I think some changes in some very important policies. I think overall, your business owner clients should breathe a sigh of relief. I think over time, the policies enacted by a Trump administration will be more business friendly than that from a continuing Democratic administration. And we'll talk about that in a little bit. But for mid and small businesses, there are some things coming that will be good for them. There will be things that ultimately will be good for American manufacturing and American economic growth, and we'll talk about those. And I think we can break this down into a number of different areas that we should understand that the Trump administration is going to take a very different approach than a continuing Democratic administration would have under Hillary Clinton. And clearly the first one is taxes. So if we look at what is going to be proposed and likely passed by a Republican Congress, you're going to have a significant tax reduction. This is the opposite of what would have happened under a Democratic administration where they were talking about significant tax increases. We think that the tax reductions and the prospect of tax reductions are going to be very positive for the economy in a number of ways. First, we think just the tax cuts themselves will be stimulative to the economy. Consumers will spend more. Second, we believe that business owners who are facing higher taxes under a potential Clinton administration will now be looking at lower taxes, more cash flow, and have more money to invest in their business, whether through additional capital investment or through hiring new employees. So we expect this to be positive for both investment in business and investment in employees, and both of those should have ramifications for faster economic growth in the economy. So, and the third piece is faster economic growth in the economy. And we think that the Trump administration policies will tend to be stimulative, pro-growth policies, unlike the Obama administration. If you look at what the Obama administration focused on, they focused on social programs and entitlement programs and transferring money from one area to another. In addition, they focused on pollution and pushing a clean energy agenda, and we'll talk about that. But it meant a lot of additional regulation, and that regulation had ramifications for job growth and the ability of certain industries to continue to exist under economic conditions as proposed by their administration. We think a lot of those regulatory pushes will go away. So, for example, when we think about who's going to head the Energy Department, proposal is gentleman named Harold Hamm. Harold Hamm comes out of the traditional energy industry, and as a result, we would expect policies that favor traditional energy industries. We think, in addition, this will mean that some of the impetus for clean tech will be damped. In other words, some of the areas like electric vehicles will not get the type of subsidies that they were pushing for to help them grow their businesses. We don't think existing subsidies will go away, but we think the push for significant increased subsidies to build out the infrastructure for them is going away. And also, for those of you who think about electric vehicles, very quietly, Tesla has announced that it's not going to be offering free charging for any future purchasers of its cars. So some of the subsidies that owners of electric vehicles have been receiving, such as free electricity, are starting to go away. So we think a more economic and market-based regime will be forced on clean tech. And we also think that some of the proposed pollution regulations that we're going to put, for example, coal plants out of business, are going to be less restrictive and probably postponed for quite some time. In addition, some of the proposed regulations on the energy industry will be put on the shelf. And in addition, some of the pipelines where the federal government has dragged its feet in enforcing the Interstate Commerce Clause will get put in place. And as a result, oil will make it to market much more easily. And also, because the pipelines are much less expensive than shipping oil on rail or by truck, this will enable economics to improve for oil producers in places like the Bakken. The reason this is important is because in the Bakken you need a higher oil price than elsewhere in the country to justify drilling. And if their costs are lowered significantly because a pipeline is put in place, this would enable for accelerated development for the economics to improve at a lower oil price. In addition, we believe that the administration will ultimately favor manufacturing again in the U.S. This will be through a combination of tariffs, and we believe insourcing of various industries. We think that this latest little hidden app in 700 million cell phones manufactured by the Chinese, where they put an app on the phone, undisclosed, buried in the software, where every single text and every single one of your contacts was sent to China, will hasten resourcing of certain manufacturing, such as semiconductors, cell phone manufacturing, etc., either back into the U.S. or Europe. We think that kind of thing will be done in the national interest. So I think that ultimately over time it's very positive for U.S. manufacturing. The U.S. now manufactures only 40% of the goods it consumes, and there will be a positive impetus for manufacturing. The big thing holding back manufacturing today is the U.S. dollar. The last time the dollar was this high was late in the Clinton administration, where the rest of the world pushed up the U.S. dollar, but you have to remember at that time that was before the WTO went into effect and we still had a large manufacturing component domestically. Domestic industry is suffering under the high U.S. dollar. It's the highest it's been in 13 years and headed higher. If we go back to the early days of the Bush administration in the early 2000s, the dollar did not actually peak until the second year of the Bush administration, but then it went straight down for the next 6 or 7 years. We think something similar may happen here, where the dollar will not peak until either 2017 or 2018, but we think it's at a level that is going to continue to cause political concerns, and that ultimately the Trump administration will force the dollar down, which will have two positive impacts. Number one, it will be good for U.S. manufacturing and make us more competitive on a global basis, which the latest rise in the dollar has hurt, which is our industry's global competitiveness. So I think that ultimately that will happen. It will be stimulative to the U.S. economy. Two, such a move in the dollar will encourage more investment in the U.S. as we become more globally competitive. So that will be stimulative to the U.S. And third, we think that A focus on U.S. trade deficits and the dollar is coming, which will also force the dollar down, because if we look under classic economic theory, there's no reason the dollar should be up 9% against the Chinese currency when China is running a massive trade surplus with the U.S. In fact, the currency in China should be going the opposite way. It should be going up, not down. So we think that ultimately currency is going to have a big impact from the Trump administration. They're going to go after the rest of the world in terms of pushing up the U.S. dollar. So ultimately those industries will benefit, but that's longer term. We think in the near term, there are some things the Trump administration will do. It may pull us out of NAFTA, and it may require renegotiation of a number of trade deals, what the president has full authority to do. For those who do not know, there are numerous laws on the book that give the U.S. president, whoever he or she is, the authority to renegotiate, to disavow trade agreements if they are no longer in the best interest of the United States. And I think with the last election, most people believe many of these trade deals are not in the best interest of the United States and need to be renegotiated. And I think they will be, and I think it will go back to a system that's similar to the GATT, which is what we used to have. That was the General Agreement on Tariffs and Trade, where everybody recognized there were tariffs, there was trade, and that you needed to protect your domestic industries from other countries using currency devaluation or subsidies to effectively put your industry out of business. So I think that's where we're headed. So that's a big grouping of things. Let's talk about some things that might affect small and mid-sized business. One thing that we see as likely under a tax reform is that the amount of CapEx you'll be able to deduct immediately will go up. The cap will probably be for small business quadrupled from $250,000 up to $1 million. Among other things, there'll be other deductions that will be increased as well, where you'll be able to deduct investment immediately as opposed to having to amortize it over a period of time. In addition, healthcare has become a big issue for small business, for mid-sized business, and for the average consumer. We expect ACA reform. We do not expect ACA repeal. We think there's too many pieces of the Affordable Care Act that are popular with the populace, such as the pre-existing conditions clause, such as the ability to keep your children on your insurance policy until they're 26, that it is unlikely that they will repeal the law. We think it will have a major revamp. We think the revamp will be focused on competition across state lines. We think the revamp will also be pushing people into Medicaid-type programs as opposed to other types of programs and into a government-run high-risk group for people that are considered very high risk and with high spending. The problem with the ACA is that it was fundamentally flawed from the beginning from an insurance perspective. What it did was allow people that had very high health care bills into the system, but it required people who were healthy to also join to subsidize and cover the cost of the very sick people. The government did not put a big enough stick in place to force young people into having health insurance. So, for example, you would have a young person who decided, well, I'm not going to pay for insurance because I'm not going to really get sick, and if I do and end up in the ER, well, then I don't have any money, so I'll negotiate a cut rate deal with the hospital. So they were not paying insurance premiums. And with only a few $100 penalty on their tax return, it was a lot cheaper than having to pay thousands of dollars every year into health insurance. So the stick was not high enough while the carrot was very high. So you got what we would call skewed distribution of people who joined in this healthcare program. And that caused the rates for those who are already involved in health insurance to soar because they needed to cover these sick people that were now in their healthcare pool. Healthcare premiums this year went up from 20% to 50% plus across the nation, and this type of rise has galvanized the public into wanting some type of reform to lower healthcare costs and to create more competition. However, do not think that this is a panacea for the healthcare industry. The healthcare industry has, as we say, fed at the government trough for 7 years. And we think that for the healthcare industry, there will be a squeeze coming. And this squeeze will be pretty explicit at the U.S. government level because of demographics, because healthcare has become too big a piece of the overall budget, and because of GDP and the need for the government to invest in other areas such as defense and infrastructure. So when you look at healthcare, we think there will be a squeeze. You'll probably get drug price regulation at some point over the next 5 years. It's unclear to us whether that will occur right away, but we think it is inevitable. Every other country in the world regulates drug pricing, and the pressure, especially as the elderly grow as a percent of the overall demographics in this country, the pressure is going to be extremely high to limit drug prices because that's one of the big out-of-pocket expenses for seniors and for many people on these new formularies. So I don't see any let-up on the drug companies. I think that's coming, regardless of who's in office, because of the economics of healthcare. Let's talk about a couple of other things. What is foreign policy going to do? We think there's going to be a much tougher foreign policy with China. We think that for companies that have been importing cheap Chinese goods, and I'm not just talking about steel, I'm talking about, let's say, engines. So why would I mention engines? So let's say a lawnmower engine gets produced in China, but the Chinese manufacturer of that engine gets subsidized steel. So subsidized steel, the Chinese government has way too much capacity, and therefore the steel is not priced at market rates and way below market rates because you can't produce the steel for what it's selling for in China. As a result, you have highly subsidized steel that's going into the manufacture of, let's say, an engine. Well, all of a sudden that engine, if their raw material costs nothing, is much cheaper than manufacturing that engine in the United States. So we think that people who are used to importing cheap goods are going to have a problem because a lot of those cheap goods, which are done through subsidies in non-market economies like China, are going to see those goods cut off. And then we think the next stage will be the attempt to take those cheap goods, ship them to a third country, and then ship them into the United States. That will be the second stage, and that will be cut off. And that will occur because the government is going to then look through and say, well, this is Chinese steel that's subsidized, that's now being used in this. So we're going to have country of origin tracking, I think, around the world, and it's going to become much tougher to send subsidized goods into the U.S. So I think that's something you should look at, and it doesn't matter whether it's a piece of steel or a piece of plastic. It's unfathomable to me how it can be cheaper to send a plastic cup from China to the U.S. than it is to manufacture it here in the U.S. And the reason is quite simple. The U.S. is a low-cost producer of energy, and in particular natural gas liquids. Natural gas liquids are the raw material for plastic. They go into big ethylene chemical plants that produce plastic. and the U.S. has a global competitive advantage in that business. As a result, the U.S. is a low-cost producer of plastics. Plastics make up the massive portion of what goes into a blow molding plant that makes the plastic cup. So it is impossible to make that same cup in China for less money and ship it across the ocean, which then costs money because you're shipping air mostly across the ocean. So when you run the economics, it seems to me that it's not just steel and it's not just other manufactured goods in the metals area, but everything manufactured using plastic. And I think this will extend to things that go into automobiles. So, for example, you might have plastic bumpers made in China. That shouldn't occur because it's a lot cheaper to manufacture those plastic bumpers here unless the government's massively subsidizing the plastic bumpers in China. So when I look at what's going to go on with trade and foreign policy and how it's going to impact back to the U.S., I think there's going to be some bumps because other countries will retaliate, but the U.S. has a lot more to gain than to lose here because other countries have been playing the game with the U.S. for a very long time. The other part that I see is there's going to be more spending on defense. And in particular, we're going to be seeing a lot of spending at the federal level in terms of upping our military, especially on the electronics, especially on various air-launched missiles, especially on drones, especially on airplanes, especially on ships, so that we can maintain our superiority over China. We also think this will result in more exports of defense goods to our allies and will result in more spending on troops and an increase in the American troop presence, which will require more uniforms, more boots, more guns, more bullets, more everything. So I think there's a lot of ramifications. I think ultimately if you look at what's going on with the current administration and how it might be different than what a Trump administration is, the current administration was very much pressing what I would call a New York, California agenda of very technology-oriented goods. And I think that what a Trump administration will push is a much more what I would call basic manufacturing that benefits the great majority of the country. And the other reason that I think they will do this is because that's where their electoral base is, and they want to reinforce their win for 4 years from now. So I think they're going to reward their base by protecting those industries and moving to increase manufacturing. And by the way, all of that will deal with the big issue for the United States, which is investment. If we look at the U.S. from an economic viewpoint, the U.S. problem right now is there's not enough investment, whether by the government or whether by business. So we know there's been a lot of talk about infrastructure, but the Republicans in Congress are kind of what I would call two-faced about that. They want to spend on infrastructure as long as it doesn't come out of congressional dollars because they're worried about the deficit, except for the tax cuts they want to put in place. So we think there will be tension between administration and the Republican Congress on infrastructure. We think that there's been a lot of talk, but to get that translated into action in Congress, I think will take some time. We also think that if, besides tax cuts, the Republican Congress does not implement something like a large infrastructure program, they're going to have to be a little bit careful in the midterm elections because there will have a disappointed electorate. The electorate was promised a major infrastructure program, and if it doesn't show up, the electorate is going to hold the Republican Congress responsible. So we think there's a lot of cross currents here. We think there's going to be tensions between the Trump White House and the Congress, because the Congress represents the traditional views of the political establishment, and the Trump administration represents a new view of how the economy should work. And that view will only slowly permeate through Congress as congressional leadership is slowly changed over time. So those are the main points that business owners should be looking at in terms of where to park their money short-term and long-term. You should understand that interest rates are going to go up. We will have inflation. We believe long-term inflation will move significantly higher, especially after 2020, but not necessarily in the next couple of years. We would not be surprised if inflation was 2.5% or 3% within the next 12 to 24 months, as reported by the government. But we also think that inflation could get up to something like 5% or more sometime in the mid-2020s. So long-term inflation is going to be a big part of thinking on things, but shorter term, it won't be a huge issue. Labor inflation shouldn't be too bad. In most recoveries, labor rates go up 4% or more per annum. In this recovery, they've gone up 2% per annum, which means real labor wages have not kept pace with inflation. But we think that labor rates will go up at a faster rate, especially as we tighten up the labor market. So if we were to think of one risk for business owners, if you have a lot of labor, you have to think about how that is going to impact you over time. The positive is that you won't get a $15 minimum wage through Congress. What you will get, though, is continuing pressure on wages through the natural economic forces in the economy. So, Sarah, that would be my quick and dirty for your business owners in terms of thinking about how a Trump administration would be different than a Obama administration or than a Clinton administration would have been. In terms of investment, we're expecting a late decade recession. It's a little hard to tell when that'll happen. That's something your business owners should keep in mind as they invest in their business. So they should make sure they have a strong balance sheet. If they want to borrow, they should borrow money today when rates are low and try to lock it in because rates will go higher. We have seen a little spike here after the election. We think rates will drift back down a bit before going up again next year. So in terms of planning from a borrowing standpoint, business owners should think in those terms. And they should also think about making sure that their cash flow is insulated for what might happen later this decade when things become a little more difficult in the economy. We do not foresee a recession anywhere near the last recession because the financial structure will remain intact. Banks are in great shape. They've got a ton of capital. The government's required them to hold a ton of capital. Lending has been very strict and underwriting's been strict, so problems in the next recession will be limited and will not endanger the financial system. The reason the last recession was so bad was because the financial system blew up. So whenever that happens, credit stops in the economy. Credit is the lifeblood of the economy, and therefore you had a big problem in the economy. But this time, credit will take a small hit, but it won't take a major nick and see an artery being cut that needs to be staunched and replaced. So we think this coming recession will be much more mild, and then the economy will accelerate after this recession as the millennials move into their prime earning years, which is another thing your business owners should think about. The millennials, which are sort of in this 18 to 34 year range now, are going to be in 5 to 8 years the leading edge will be in their late 30s, early 40s, and that's when people maximize or start to maximize their earnings. So they'll be starting to move into their spending years, and that should also accelerate economic growth after the next recession, probably after 2020. So that's another factor your business owners should think about. Lastly, in terms of their own long-term retirement goals, we like the stock market long-term. We think that returns from where the stock market is today are limited on a 5-year basis, but we think whenever we have the next bear market that business owners should invest heavily into the market because growth will accelerate, which will accelerate corporate earnings, which will also accelerate the rate at which the stock market goes up. So that's kind of our personal viewpoint as to where we are. In terms of things like real estate, we're a little leery because interest rates are so low and valuations on real estate are very high on a historical perspective for real estate. And if we get more inflation, say in the 3% range or 4% range, and regular interest rates go to 5% or so, and cap rates go to 8% or so, up from 5% today, you could have a major valuation compression in real estate, even with a growing economy. So we're not as positive on real estate as we were 5 years ago. And that is really the other major asset class that most small and mid-sized business owners who have some capital consider. And so we would wait until a recession where you might get a better buy on real estate. And Sarah, I think that's it, unless there's something else that I haven't covered yet.
No, that's great, Paul. Yeah, I was going to ask about the real estate folks, but you just covered that at the end there. We have a lot of folks that invest and, do that either as a full-time business or a side business. So that's got to be super helpful.
Well, I've been a lot of presentations on real estate lately, and I'm very positive on single-family homes for real estate investment. Buildings which can be bought, rehabbed, and resold to the millennials, especially starter home levels, because the millennials are moving into buying starter homes. We're less positive on multifamily apartments because from 2020 to 2025, the prime demographic that rents is going to have zero demographic growth. And that just can't be good for multifamily apartments. So you could have a real period where there's no positive factors underlying the multifamily apartment regime. But we do like single-family homes. And if you were to think of it from an investment perspective, starter homes are good now. After 2020, the millennials will be ready to buy what I would call move-up homes. So the more expensive homes that aren't selling today, let's say those in that sort of $1 to $2 million or $1 to $3 million range that are having trouble, let's say, in the Philadelphia area selling, those will accelerate in terms of want and value because the demographics will now have the millennials moving into buying those homes. The one other category of real estate we're not so hot on has been high-end hotels. There's a lot of capacity being built at the high end, and we're already beginning to see weakness there. So I think real estate is really a category by category, Sarah. Mm-hmm. So I've made some generic comments about real estate, but, as we know, all real estate is local. And even if multifamily is not great overall, there can be certain cities where there's significant growth going on, and that might require some housing to be built that's multifamily. And in those cities, things might be okay for multifamily.
Okay, gotcha. That's very helpful.
Okay.
Okay, so thank you
So we
so
covered
much
real
for,
estate,
yeah. Hmm.
we covered capital investment. Now, here's the other thing. If any of your listeners would like to learn more or see how this would impact their individual business, we're happy to talk to them and give them a half hour of our time for free. We do this typically as part of what we do for our clients, but we're offering your listeners a free half hour of our time, and they can reach us at our business at 610-687-7766. That's our general business line, and ask for me. Or what they can do is they can go to our website and fill out our form, and we'll be in touch with them to arrange this. Just on the form to say that they got the offer from here, because this is not something we generally do for people unless it's a specific reference to this seminar that we've given. And alternatively, on a last bit, they could contact me directly, which would be psloat@greendrakeadvisors.com, and I'd be happy to talk to them, Sarah.
Oh, thank you, Paul. It's a really generous offer that I hope and I definitely encourage the listeners to take advantage of. And if they, didn't catch that while you spoke, your contact info we have up on the screen right now with your phone number and your email, and that, will remain available to them. So thank you so much for your time today. That was very generous of you. And thank you again for the offer. And we hope that a number of folks take you up on that. And I know you do a lot of speaking. You're a very sought after speaker. Do you have any upcoming talks anywhere in the area where people can find you?
Yes, I actually have a lot of upcoming talks coming up. I'll be talking down at the Union League in 2 weeks for their business network with a 2017 economic outlook. In addition, I will be doing a number of other events in and around the Philadelphia area. I'm going to be talking for the JBN of Philadelphia in mid-December. I'll be talking in January at Drexel University on January 19th for the Financial Executives Institute and the Drexel alumni. In addition, I'll be talking up in Princeton in early January for the Princeton Business Network and for a number of other organizations around Philadelphia.
Okay, perfect. And I would encourage, anyone listening today to go seek out one of Paul's talks. Like, they're very informative. A lot of information, a lot of data, very good for just your understanding of the market and the economy right now, and, obviously how that might impact your business. So I definitely hope people find you at a future talk.
Well, thank you, Sarah, and thank you so much for this opportunity to help your clients. I hope they learned a bunch from what we spoke about today, and I hope they really take up on that offer I gave them, because I'd really like the opportunity to help them in some way.
Yeah, and thank you again, Paul, so much. Have a great rest of your day.
You too. Have a great day, Sarah.
Okay, thanks. Bye-bye now.
Bye.